we'll hit it off with hearing from you. First, I'll ask you to present yourself and the local seed you're in, so Chicago, London, and New York, and the largest changes that you've experienced in the past 12 months.
Going this way? Hey everybody, I'm Ezra, run a fund called Starting Line. Thanks so much for having me. It's super exciting to be back in Tel Aviv for the first time in a decade, actually. Starting Line is based in Chicago, seed stage. We focus mostly on consumer. We call it consumer VC for the 99%. And that means that we're historically focused on opportunities that we believe are both cheaper and better, create an enormous amount of consumer value. So in theory, that works well in good times because people want to live a more aspirational life. In theory, it works well in bad times because people are hedging their lives. So we will see, TBD on that. Biggest changes? I don't know. I think we've been talking about it all day. I don't think I have much to add from that last presentation.
Hi everyone. It's the first time I've been at a vintage conference, and if this room is anything to go by, the ecosystem here is in really great health. So it's great to be here.
Thank you.
You heard a little bit. We've founded our fund in 2003. Saul and I have both been entrepreneurs prior to that, and I think that's the heart of our philosophy as a fund, is we're very focused on founders. I think most funds say they're founder-friendly, but I think true empathy comes from going through the whole process. What has changed? I think, we've been through a few cycles, and this cycle, I don't think, on the face of it, is very different from the others that we've seen previously. In these times, what we see is entrepreneurs coming and wanting to build great companies. 2008 vintage, I look back at it, we've returned 4.5 times capital. 2012, we're probably never going to see it again. We're coming up for 10 years. We've returned 15 times. So we are very positive about where we stand right now. We think we will attract great entrepreneurs because the fundamentals are great and the opportunity for building great companies. What has changed is I think we want to fund companies for longer than we previously did. So we're writing bigger checks, but we are writing checks. And, we're very fortunate that we're investing at seed. And seed, as you know, it's a long game. We've got to go through many cycles before we return capital. So the blips in the market, we can ride out. That's our position. That's our view.
First off, thanks for having me. My name is Jason Shuman. I'm a general partner at Primary. We were founded back in 2015. We're the largest seed fund in New York City. Our model is pretty unique in the fact that we're trying to redefine the way that we work with founders. So we're a highly concentrated portfolio. We're exclusively focused on New York City. And then we have the largest portfolio impact team of former operators and executives that go in and they work with all of our companies on 3 things. So recruiting, go-to-market, and then strategic finance. I was actually in high school during the last cycle, so I probably can't talk that much about that. But for me, I've been in venture for about 8 years, and the biggest difference now versus like 8 years ago is the multi-stage funds coming down into seed. I mean, they never played here, back in the day, and now it feels like they have every single partner writing a dozen plus seed checks a year, and that's a big difference for sure.
Great. So I'm actually going to change the order of questions because of, Robin, what you said about that this is a very good time to start companies and to invest in companies. And we've all been hearing this phrase, right? How iconic companies are built in financial downturns. So these are all very good reasons to be excited and to deploy money faster into seed companies. And my question to you is, are you indeed picking up your pace? And if not, why?
I'm happy to take that. We're not picking up the pace, but we are investing more capital. So whereas we might have said we want seed companies to have at least 18 months of runway, we're now saying 24 minimum. And if it's deep tech, we're looking for 3 years. That means writing a much bigger check. We might want a slightly more ownership at that point. And I guess, if you're writing a bigger check, perhaps you're more selective. The power law means we've got to have decent size portfolios. So our portfolios generally are at least 35 companies, and we raise capital every couple of years.
We're doing the same thing as Robin. I think one thing to note though is like we never changed our pace. Even during like the up market, like we have a commitment to the founders we work with, which is we're doing 3 to 4 deals a year per partner. That way we can actually lean in and like be able to work with you. And so we didn't increase our pace before. We're not increasing the pace now. Our check size, is certainly increasing, and we're thinking about reserves in a different way. But that's the biggest thing is just trying to stay steady because time diversification we think is really important, and so is the commitment to founders.
Yeah, like Robin and Jason, our pace has also been consistent, 2 or 3 per quarter. We did 3 last quarter. We'll probably do 2 or 3 this quarter, which is our normal pace. I think the one difference is my fund is materially smaller than yours. So when we think about, hey, can we fund a business for 24 months? The answer is no. So when we're making those decisions about which companies are going to make it into the portfolio in this environment, we do need to think a lot about which founders, even if we, let's say all things being equal in a vacuum, we like the market, we like the product, et cetera, which founders inherently have a higher likelihood of raising capital because it is a reality that we need to think through as a smaller fund.
Great. Let's talk a bit about valuations. So I'm not going to ask you the obvious questions about is our valuations down because we saw the data and we see that in seed they're still high. So 2 more nuanced questions on that. One is, are you seeing what are the differences that you're seeing in valuation? So for example, between new founders and experienced founders. And the second, if you are seeing an outlier funder with an excellent value proposition that wants to raise in a 2021 valuation, what do you do with that? And how do you balance between the discipline and winning best deals?
I'm going to be a bit controversial on this subject, I think, especially with LP in the room. We're not very valuation sensitive at all. And I look back a little while ago at some email exchanges I had with the founders of Wise, TransferWise. And I'm a bit embarrassed to say I was really negotiating very hard. And the valuation was, at the time, $6 million. And they IPO'd at, $10 billion. So would it have made a difference had we paid $8 million pre-money? No difference. So what's really, really important is finding the right entrepreneur. And if you found the right founding team, the right entrepreneur, if you pay a little bit more, bit less, it really makes very little difference.
Do you think that calculus would have, can I?
Yeah.
Do you think that calculus would have changed in the most recent market where there were entrepreneurs commanding a $40 million valuation at launch versus, versus potentially a 20? Meaning 40, it seems like you're inherently limiting your set of outcomes.
Yeah, look, I think you have to believe when you're paying 40, you've got to believe that company is going to be a multi-unicorn. I mean, we have a threshold when we look at a company. We want a single investment to repay the whole fund. So it's not 10x or 3x or whatever, the whole fund. So as your fund gets bigger, you're trying to visualize something which, in a lot of cases, you can't see. So we turn down more good companies because they just won't get big enough to return the fund.
I don't know. I think it's complicated. I think I'm a lot cheaper than you are, which is okay, I think, to a certain degree. I mean, we do have a bucket of must-win founders and must-win deals. There was one recently, a must-win founder, like our number 1 priority for the quarter. And this founder basically pre-launch wanted a $50 million valuation in July, September of 2022, which is high. So we successfully, over a period of weeks, worked the founder down to a $20 million valuation. We led the round, and 6 weeks later, they got a term sheet at a $50 million valuation, so I just kind of shrugged, right? So there is stuff you can do there's always levers, but as much as I thought I was smart of saying, hey, this company is not gonna get a valuation like that in this market, I was wrong.
So I was having a conversation with a blue chip VC recently from the Valley, and he was telling me that his firm has a rule, which is that they'll always do seed deals and second-time founders that had success before, and it didn't really matter about the price. And perhaps Rob and I also have a hot take, which is like, I think, if you have a good founder and they're in a great market, I'm okay with being, price insensitive and doing it at whatever price is necessary to get the deal done. However, if you have a great founder and they're in a bad market, the market's going to keep its reputation, the founder's not. So don't do that deal. I mean, we're investing, as I said, 3 to 4 companies a year, and we looked back at the data of second-time founders, and we found that when they went to market in bad markets, more often than not, they had trouble hitting the valuation they needed to hit to raise an up round next time around. And so, to get even more recent, we had a portfolio company founder that had a pretty large exit in the mid 9 figures previously. And the founder asked us to help with them developing an idea. And so we did. And we spent 3 months working with them every single week. And we walked away and said, hey, we don't like this market. We don't like this concept. And they were like, well, I do. And they went out and they raised a 5 at a 25 post. And we ended up passing and not working with them, because in this market, if you're going to end up having to pivot, in a year from now and burn through $3 million of cash, you're not going to hit the milestones to be able to raise the next round at an up round. So we don't want to sign up for those types of battles. Nice.
Very, very interesting insights about valuations. Let's switch gears into portfolio support. So a lot of conversations also in this room about supporting the companies through the rough times ahead, reducing burn, increasing runway, etc. Can you share a situation in which you had a real dilemma with one of your portfolio companies about this transition and what you ended up doing?
I guess I'll take this one first. I think there's a lot of companies undergoing change right now, and in each specific case is very unique. We had one company in particular where they raised the Series A when the market was hot. It's a business that eventually one day is going to monetize via a marketplace model, but it had a very West Coast-like vision, which was, let's go out, let's scale to free users, let's show like a projected average revenue per user in the long run. In the meantime, we're going to run an experiment on monetization in California. And we'll show that and use a projected, average revenue per user to raise the next round. Well, we're in 2022. We've all seen the stock market. It's a little bit harder to underwrite businesses when you're using assumptions, around how much you're going to be able to actually project out. So we had to reshift the business, and we had to let go of some people and realign the teams around monetization. And now we're 100% focused on the marketplace. And we are 100% focused on bringing people in that can effectively execute on the marketplace. And as a result, you've had, this shift in culture, and really the only people we're keeping around are the types of people that can put points on the board.
I think the toughest thing one has to do is when there's a change in founder or one of the founders. And unfortunately, over the long career I've had to go through that a few times. And this is where I think your VC support is essential, because it can undermine the entire organization and the culture of the organization. And generally, it doesn't work. And conventional wisdom would tell you that once the founder leaves, that's probably not going to become a great hit. So I think, but we've had 1 or 2 exceptions to that. And I think it's just taken a lot of time and a lot of additional engagement over and above the kind of support that we would generally give.
I just think in terms of the kind of, are companies cutting back? Are they cutting runway? It's an interesting time in that I think the instinct for a lot of founders, because they read the press and they hear everything, is to call us and say, hey, should we cut back? And we, present to Vintage and all of our LPs a runway tracker. How much runway do our companies have? But ultimately, it's kind of about what are you driving towards? What are you trying to accomplish? So there are certain companies where I'll give you one example where it makes sense. So we're invested in a crypto company that actually is doing quite well. They earn a lot of money. But the amount of money they earn is tied to the size of the crypto market, which is down 75%. So the TAM that they can monetize is down 75%. So they actually weren't planning to cut back because they're doing pretty well. My message to them was, guys, let's take a look out. Do we all agree that if we exist 10 years from now, we will be a great big company? And the answer was yes. Then the question is, well, given that the monetizable TAM is down 75%, at least now, and potentially for the next year, 2, 3 years, does it make sense to keep accelerating burn when we know that if we exist 10 years from now, we'll be a big business, but we don't know if we'll exist 3 years from now based on the current burn, right? So that's a situation where it makes sense. We have plenty of other companies where they're still iterating on product market fit. And it's like, well, if we cut burn there, what are the trade-offs between finding product market fit? So I don't think it's as simple as cut burn to extend runway to get through this. I think it's very company specific.
Great. One last question. Let's talk a bit about fund sizes. So the clear trend of the past few years was grow your AUM and raise an opportunity fund. But now actually round sizes and valuations are hopefully going down, also in the seed. And the difficulty to fundraise goes up. Any thoughts about the size and structure of your next fund, and any chance we will see your fund size get smaller?
We're strong believers that your fund size is your strategy. And if you're a seed fund, you can't get too big. And we've been very fortunate that we've been oversubscribed. Every time we would expect to be oversubscribed, but that does not mean we'll raise a larger fund. What we did, however, was we launched a breakout fund, and we deliberately gave it a different branding. We call it Latitude, and we're now on Latitude 3. So these are companies that break out of LocalGlobe and are ready for growth. But we wanted to keep LocalGlobe as a brand which is associated with seed. So I won't say we'll never get bigger than 200 million, which is where we're at now, but it feels already sort of uncomfortably high, let's say. And I guess one of the reasons we're able to deploy more capital and require greater ownership is because it is large for a seed fund.
How big is your fund, by the way, between LocalGlobe and then Latitude?
If you add the two together, it's about 500.
Yeah, I mean, Starting Line has been small since inception. It's still very small today. I assume we'll stay small for the foreseeable future. I think one of the questions, I was out in Vegas last week and there was the Goldman conference, and the vibe seemed to be like people smell blood in the water. So it'd be interesting to see if the growth firms try to stay as deep as possible, trying to stay as aggressive as possible with more cash. That I can't predict. You guys would have a much better vision into that. But yeah, same strategy on our end.
I mean, our point of view is you either need to stay small or get big, or you're going to die if you're in the middle, like full stop. And the reason why is, we just raised a $275 million core fund and then a $150 million opportunity fund. And the resources that we can now bring in-house, we have 28 people on our portfolio impact team. We're spending $4.3 million a year on operators to help out with the 3 things I mentioned earlier. And then we have an 11-person investment team that are going out, doing outbounds, becoming specialized in industries, and able to really add value to portfolio companies in just completely different ways than these smaller shops. And so our belief is that we can not only buy ownership, but we can also go in and support these companies and win deals over most other funds. Meanwhile, if you're small, you can play nice in the sandbox and, you can either lead some deals, especially when it's in your network, or you can follow. And so for us, we're going to continue to make sure that our fund size is at an optimal level, which I think we feel like we're at right now. But, shrinking from this point, I don't think is an option.
Great. Thank you very much for a very insightful session.